All right, everyone. I think it's time to get started. Thanks for coming out to our presentation tonight. I will be talking about preparing for the biggest investment of your life, and yes, I'm talking about buying your very first home. So let's talk about home ownership and why buying your own home is very important. I'm going to say that it's probably one of the easiest ways to build your own wealth. You have to pay rent to somebody anyways in order to live. And so one of the easiest ways to build an investment account for yourself is just to be paying yourself, paying down your own mortgage, right? If you look at it and figure out, okay, what would I do if I was renting versus what would I do if I was owning? In many cases, home ownership is more expensive than renting. Now, I will say this, that it's not always more expensive, but in many cases it is. Home ownership becomes a forced savings account where you're just effectively paying yourself money. And that's because you're paying down your own mortgage. And one of the things that's actually a really easy way to look at the total cost of home ownership is if you look at how much you pay in rent and how much you would be paying if you were to own your own home. Look at the property taxes, the strata fees, the mortgage payments, etc. And let's say that renting is $2,500 a month and owning is $3,000 a month. If you look at that $3,000 a month, however, and look at how much in your mortgage payment you're paying down on the principal, you might be paying off $800 a month in principal. And so you might realize that, oh, geez, although actually I'm paying $500 more, I'm paying 800 of the 500 into my own pocket. And so really the amount of flushing down the toilet every month is $2,200 a month if in the home ownership example. So you do want to make sure that you factor in the fact that you are often paying down your own mortgage, and we call it a forced savings account. And it's actually one of the best ways of saving. If you have to make a payment every single month, guess what? You actually make that payment. A lot of people end up saving and they say, oh, I'll spend and then I'll save the rest. Those of you that are good savers obviously save and then spend the rest. But when you have a payment that has to go out, it's often one of the best ways of forcing yourself to make to actually contribute to your own future net worth. Payments build equity as well. Not only are you paying down the mortgage, but also over time, you would expect that the home will go up in value. So by every single payment, you're paying down a certain amount on the principal. We see the amount that goes down towards the principal will go up and down based off of where interest rates are heading. 15, 16 years ago, when I first got into the business and interest rates were 6% and you can get a 40-year amortization, only about 9% of your first payment went towards the principal. Just about a year ago or a year and a half ago, when interest rates were below 2%, closer to 50% of your first payment went towards the principal. In fact, in some cases, it was even 60%, which is crazy. As of right now, between 20 to 30% of your first payment goes towards the principal, depending on the interest rate and the term that you choose. So every payment that you make is actually paying down not just the interest, but it's actually paying down the principal. Now, of course, one of the primary reasons to own a home is that the average home price generally appreciates. And so if we look at where real estate markets are, obviously Vancouver and markets like Toronto, those seem to be very safe places to park money. They seem to appreciate quite a bit. The Vancouver annual appreciation on average has been close to 6% over the last 35 years. Perhaps even higher than that after the last few years of COVID, because I think that 6% number was actually a number pre-COVID, and COVID, of course, saw values go up by about 20 to 30% for about a year and a half or 2 years there. But even if you took the average home price in Canada and looked at that over a long period of time, so I remember seeing some data that went back to, I think, the mid-50s when they started tracking the average home price in Canada. You actually can't find a 10-year period where the average home price in Canada is not higher after 10 years. So no matter, take it over any recessionary period, over any period from about the mid-50s, you will not find a point where the average home price is not higher after a 10-year period. Of course, that's over all of Canada. There's going to be some markets where maybe it was a small town and the mine shut down. And of course, values are going to drop in that type of climate, but it's pretty safe to be investing into a major urban center like the Greater Vancouver market, Greater Toronto market, etc. One of the cool things is you can borrow against the equity, which is kind of neat. And so as you pay down your mortgage, eventually you may get to a point where you can actually tap back into that equity to borrow to do other things with. And one of the nice features about home ownership is that borrowing against your home is some of the cheapest debt that you can ever acquire. And that's because from the bank's perspective, it's the safest spot to lend on, because there's such strength in the asset and the underlying collateral itself. And so if banks also expect that home values will continue to appreciate, then banks are more willing to lend against it. And you can get longer amortization. So as an example, if you buy a car and you get a car loan, for a long time, you would get up to, a 5-year car loan, and they start to stretch them out to 7 years. You can get 8 years, but even that pales in comparison to the amortization you get on a mortgage. A mortgage loan can be stretched over 25 years, or if you're putting more than 20% down, can be stretched to even 30 years. So there's more options to actually have a lower payment when borrowing against a home. One of the things that we also talk about and educate our clients on is eventually, if you look at investing in real estate, you can also use your home as a hub to borrow against, to then leverage and invest in other things. And when you do that, the interest portion of the payments is tax deductible. And so this is another concept that, of course, I recommend that you talk to an accountant before you do, and also talk to our team. A lot of our clients do invest in real estate, and so this is something that we'd love to talk to you more about. But one step at a time. If you're looking at buying your first home, borrowing against it to invest is something that is in the future. But it is important to remember that this is one of the reasons why you do want to own a home. Now, last but not least, it's nice to have some control over where you live. I can't tell you the number of times that people call us and we ask them, why are you reaching out to us now to buy your first home? And the common theme here is, well, the landlord is actually selling the home, so now we have to move. And so if we're going to move, we might as well try to find a place that we can move into and settle into and own ourselves, because we don't want to be told that we have to move once again. And we've dealt with some people, I'm sure a number of you that are watching this know some people that have had to move 3 times over a 2-year period, because they move and then all of a sudden the landlord says, oh, sorry, my family's moving into the property, or hey, sorry, I'm selling the property and the new buyer is going to move into it. So it is very nice to have some control over where you live. So these are some of the primary reasons why you want to consider home ownership. Now, one other really, really important key to this is that homeownership is a way of building wealth. It's a very easy way of building wealth. There's some stats out there that suggest that 90% of millionaires made their first million in real estate. And the reality is there's a lot of millionaires in Vancouver, and a lot of those millionaires just bought a home and have owned it for 30 or 40 years. But that trend is not a recent trend. It's not just a Vancouver trend. This trend is a trend that stretches across North America, stretches into Europe, etc. A lot of people just make a lot of money by just buying and owning their own home. It's a really simple investment, and the earlier you start, the better your net worth will be in the future. There's a lot of benefits of being a first-time home buyer, so I'll go through a number of these. First of all, the one that we've known about for quite some time is the RSP homebuyer plan. And so the RSP homebuyer plan allows you to withdraw up to $35,000 out of your RSPs tax-free, and this is per person. So if there's a 2 partners involved, then each of those individuals can pull up to $35,000 out of their own RSPs. So that would be combined $70,000 in RSPs, and you have to repay the RSPs back over a 15-year period. Now, the nice thing about doing this is that when you contribute into an RSP, all of the money that you put into it is tax deductible. And so you actually get to write off a little bit of your income. So if you put $5,000 a year into your RSPs, it reduces your taxable income and you pay less tax, and I should say no tax on the $5,000 of income, which is a really nice thing. So this is something that is a nice feature, and you can then put money into your RSPs and start to contribute that money in there, and then eventually you can pull the money back out when you're ready to buy your first home. This is something that the government has been doing for a number of years now, and every year they still have to review this with their budget. But as of now, there's up to a $1,500 tax credit on next year's taxes. So when you file your taxes, Let's say that you bought a home in 2023. When you file your 2024 tax return, you may be able to be eligible for up to $1,500 in tax savings by actually filing this. I should clarify the tax credit is a $10,000 credit, which means that you may get up to $1,500 back on your tax return. So it is a pretty substantial amount of money. It's not small chump change. It used to be $750 when they first came out with it, and they've since bumped it up. Another big one, and this is probably one of the large ones. Now I will say that it is less relevant because of the size of the amount, but there's no property tax on certain price points, and so different provinces have different property tax rules and legislation. So I'll speak mostly to the BC property transfer tax rules here, because most attendees are from British Columbia. But in BC, you do not pay any property transfer tax if you're buying a property under $500,000. And if you're buying something between $500 and $525, then you pay a percentage of the amount. If you buy over $525,000, then you pay the full amount of the tax. There's another unique rule to this too, that if you're buying brand new, then this threshold is up to $750. You don't pay any property transfer tax. Between $750 and $850, you pay a percentage of the amount of the tax, and then $850 and over, you would pay the entire amount. Now, to give you an idea of and some perspective here, the property transfer tax is 1% of the first $200,000, and then 2% of the balance. Actually, once you hit $2 million, it goes up to 3% on any amount over that. So it does get quite expensive. Most first-time home buyers, however, are not buying a $2 million home. But to put this in perspective, if you were to buy a home for, let's say, $600,000, you'd pay $2,000 on the first $200,000, and then on the remaining $400,000, you'd pay 2%, so that's $8,000. So in total, the tax would be $10,000. So there is a large financial incentive to try to stay underneath that $500,000 limit. What's the problem? Well, try to find something under $500,000 in BC. That's not 300 square feet. So that's the tough part, obviously, is it really limits the type of property that you can buy. I do find it odd that policymakers have not changed this number, and it's been quite a while since they've changed this number. When I first got into the business in late 2006, I believe that the threshold used to be $375,000 to $400,000, or $400,000 to $425,000, somewhere in that range, give or take $400,000. Property values have probably gone up, 80%, 100% or more over this last 15 years, and yet the property transfer tax threshold has only changed by about 20% or 25%. So I find that odd, and I'm wondering at what point does the BC government perhaps look at increasing this threshold in order to accommodate and help more people. Hasn't happened yet, but it is something that I'm very curious to see if they may change in the near future. So this one is a new one. If you're saving for your first home, there's the new proposed, well, I shouldn't say proposed because it actually just got launched. It's the tax-free account. And so they call it the FHSA, First-Time Homebuyer Savings Account. It has a number of different features regarding the FHSA. Similar to the RSP, you can contribute money into it, and then you can withdraw the money and up to $40,000 tax-free. Any gains inside of it are not taxable, just like an RRSP is. One thing is that you can convert it to an RSP after 15 years, or if you reach the age of 71. And so if you decide never to buy a home, you don't have to actually use this money and do anything with it. So this is one nice little advantage and way that the government is trying to help people that are trying to get into home ownership. They do restrict the contribution to just $8,000 per year. And there are some thresholds, which I won't get into too much detail here, but if you don't fully contribute the previous year, there are some mechanisms that allow you to catch up. So if you didn't fully contribute enough the previous year, there may be ways that you can contribute a bit more. And one thing that was interesting is when they first launched this, they said that they would not allow it to be combined with the RSP homebuyer plan. However, they've made the decision that they actually will be combining it with the RSP plan, which means that you're able to withdraw money out of the FHSA account, as well as the RSP account to be able to contribute even more money to your down payment. Now, in addition to that, there's also Canada's first-time homebuyer incentive. So for those of you who remember, back in 2016, 2017, or maybe it's 2017, 2018, BC came out with the BC Home Partnership Program, and it was effectively a program where they would combine and allow to actually lend you some of your down payment that's required. And what they're suggesting here is that they say, well, if you need a little bit of help with being able to qualify for your mortgage, then what we'll do is we'll actually contribute some of your down payment, and we will not charge any interest on that amount. And so this is a program that we haven't actually seen very many people utilize as of now, but it is a way of reducing your down payment requirements. And so you can get up to 5% of the purchase price, and it's up to 10% if it's a brand new home, as an interest-free loan. So they'll lend that money to you. They will match what you put in or give you up to 5%. So if you're only putting up 2.5%, then they'll match your 2.5%. If you put in 5%, then they'll give you another 5%. The maximum income allowed underneath the program is $150,000. That's the household income that's being used to qualify. And the max loan is 4.5 times your income. And so it does restrict, to a certain extent, the maximum loan that they're willing to do underneath this program. Now, one key feature of this incentive is that you're effectively saving on the interest cost because the government is covering that interest cost for you. But then what they expect you to do is when you do sell the home, you have to pay them back on the appreciation that has occurred. And initially there's no limit on this, and then they tweaked the program a little bit to say, hey, you know what, let's just cap it at 8% per year. And so effectively what they're saying is, we're gonna put some money into this for you. You don't have to pay any interest on it for the first 5 years, but then after that first 5 years, ideally you pay us back. But if you don't, then it switches into a loan, and you do have to repay us at current market rates, which their target is prime plus 0.5%. Right now, prime is 6.7, so that would mean that as of today, a loan clicking into that 6th year would then be paying back interest at 7.2%. Now, also keep in mind that there's additional legal fees, perhaps appraisal fees. Insurance sometimes costs a little bit more if you have a first mortgage and a second mortgage registered against the property. And so there actually are some additional costs involved. And this is one of the primary reasons why people didn't typically go through this program. But there's another main reason too, and this may change actually moving forward. See, if you really drill it down, what ends up happening is you don't pay the interest, which is saving you based on today's market rates about 5% per year. But then you're having to pay back the appreciation. Now, what happened is a couple of years ago, COVID happened and interest rates went down significantly and the appreciation went up. And so the conversation we had with a lot of our clients was, well, you could be saving the interest cost on, let's say, a loan of 2%, but then you're going to be paying the government back on the appreciation, which was 10, 20%. So the numbers weren't quite aligning. Now, obviously, we wouldn't expect, and I would never tell somebody to expect a 10 or 20% annual appreciation every single year. However, it was something to make sure that you considered. We do usually expect annual appreciation to be, approximately 3% as a nice conservative number. And as I mentioned earlier, I think that Vancouver is closer to between 6 to 8% over the last 30 years. So the question then becomes, yes, saving on that interest cost may help with your budget to get into the home. But the challenge then is, does it actually help your future net worth to get into a property and have the interest-free loan, because it's going to cost you later. They're going to still have to get paid back on that amount of the appreciation. And for the longest time, the appreciation rate or projected appreciation rate was higher than the interest cost. Now, in the last 12 months, things have changed. The marketplace has been slow. It has declined. I will say that recent trends are showing us that it's possible we've hit the bottom. It could be a short-term bottom and maybe things go up and then come back down a little bit. Who knows? But as of right now, it seems like the market's definitely picking up, and every person that I talk to in the real estate market is very busy right now. So we may have hit the bottom. And then on the interest rate side of things, interest rates have obviously gone up, and so maybe it makes more sense to consider this program today. But I'll say that for the most part, I think we only did one transaction like this in the last couple of years since it was introduced, and all of our clients have been opting for it. But I'm wondering what happens moving forward. It'll be interesting to see what people think. Now, one little other financial benefit that I want to talk about with being a first-time homebuyer is actually the interest rate. It will probably surprise you to find out that if you're a first-time homebuyer putting 5% down on a property, that your interest rate would be better than your parents' interest rate, and your parents might have $1 million down payment on a $2 million home, and they might have $1 million in stocks and other assets and higher income than you and perhaps a better credit score than you. But interestingly enough, what happens we're going to get into this in a couple of slides, your mortgage becomes insured. So when you put less than 20% down, you have to get insurance on your mortgage, and it gets added to your loan amount. So it's through CMHC or one of the other two mortgage insurers in Canada. And because the mortgage is insured, it means it actually protects the lender in the event of you defaulting and not being able to pay your mortgage. And so if you don't pay your mortgage and the bank loses money, because hey, let's admit it, if you put 5% down, there's not a lot of spread there for the values to just decrease just a little bit and other banks underwater. And that's why CMHC was created back in the 50s, actually. And first, it was created to help war vets who were returning back from the war to get into their first home. And then there was obviously some talk about, hey, that's not really fair that only war vets get it. Let's introduce it to everyone, and that's where CMHC's roots came from. And so what ended up happening here, especially in the subprime crisis, is lenders lend out money and then they actually bundle up bundles of mortgages and sell them. They're called mortgage-backed securities. And when the subprime crisis happened back in 2008, it got more expensive to sell bundles of mortgages. But you know what the investors that buy these bundles really liked? They liked the insured ones. They liked the ones that were backed 100% by the Canadian government, because then if the deals or the properties go belly up, they know that at least the government's going to repay them. So those mortgages are actually the most profitable because they're the lowest risk and the easiest ones for the banks to sell and get off their books. And so it's a little bit of an economics lesson. I didn't want to go too deep into that. But what I'm trying to say is that the lowest rates in the marketplace are actually for first-time home buyers in general, or just anybody buying a property with less than 20% down, which I should clarify and add too. You do not need to be a first-time home buyer to buy with less than 20% down. You just have to be buying your own personal residence, and then you're eligible to buy with as little as 5% down if you're buying under $1 million. So something to keep in mind. But it's interesting that you'd actually get a better interest rate. And in fact, we usually use what are called non-bank lenders for those loans, who have very competitive insured mortgage pricing compared to the banks. And so a lot of the time that we find a mortgage broker is very well suited to serve a first-time home buyer, because the interest rates through the other lenders that you can't access unless you go through a mortgage broker are often much more competitive than major banks. And not always, but often, especially for insured mortgages. Now, if you're not sure, based off of all this information of whether you should rent or whether you should own, I'm a spreadsheet guy. I like my spreadsheets, and I created a rent versus own analysis. And so feel free to go to the website or to email us, and we're happy to send you over a copy of it. Well, what it allows you to do is punch in your monthly rental income, what it costs for your utilities, and what your current savings rate is. So if you have excess cash, what rate of return would you be getting if you were investing it? And we compare that versus what the purchase price would be, your down payment, your mortgage payment per month would be, property taxes, strata fees, etc., on home ownership. And you also put in what you expect the annual appreciation to be. And what it will do is it'll calculate what your future net worth will be over whatever time period you select if you were to go rent and continue to rent versus own. And the cool thing is it tries to compare everything and really break it down so you're really comparing apples to apples. Because in that example I used in the very beginning of our presentation, if you're paying only $2,500 a month to rent and paying $3,000 a month to own, then it says that, hey, if you're renting and only paying $2,500 a month, then in theory, compared to owning, you'd have an excess of $500 a month that you could be investing. So it takes that $500 a month and it puts it into the market. It also even puts in the percentage and the amount of down payment that you would need to buy your home, and it puts that into the market at that prescribed savings rate. So really, I tried to give a very objective way of looking at owning versus renting, and you'd be surprised. Using a 3% annual appreciation, you'd have to have a very high savings rate in most cases in order to be able to have a higher net worth after 10 years. Unless in various rare circumstances where you have a very, very low rent, or you're living in an area where the values are very, very high compared to the rents. And so some very high-end areas of Vancouver, for instance, might have a very expensive property price and the rents aren't quite pacing with that. And in some cases, if you really want to live there, then yes, it may make sense to continue to rent and save the rest. But if you're not convinced that the home ownership makes the most sense for you, then feel free to use our rent versus own calculator, and it'll help you calculate all of that. Now, getting your first home, it's very important to get prepared. There's lots to do, so let's get to work and go through what's needed in order to buy your first home. So first of all, start saving. A good way to start to save is to figure out how much it would cost in total to own and save the difference. And that way you can avoid that payment shock. So if right now you pay $2,500 a month in rent, and it would cost you $3,000 a month to own, then start to save that extra $500 a month and make sure that you can afford a total outlay of $3,000 per month. Make sure you can do that before you get involved and before you buy a property to make sure you can afford it. It's very important to get your credit in good standing. If your credit is not very good, you will need good credit. Ideally, you want your credit score to be over 700. If your credit score is not over 700, you can still sometimes get a mortgage depending on your credit score, but it does get a lot more difficult. You're aiming for at least 660 plus, but in many cases, a lot of lenders require 680 or 700 credit score or above in order to get qualified for a mortgage. So make sure your credit is in good standing. Make sure you pay all your bills on time, pay off any collections, things like that to make sure that your credit's okay. And obviously, it's important to get connected with a good mortgage broker to get a pre-approval. The pre-approval does two things. It allows you to ensure that you have a rate hold set, so that way if rates start to climb up on you, you have a rate held for up to 4 months, and that will allow you to make sure that you have some cost certainty with that. And the second thing it does is it confirms and validates what your maximum borrowing power is. You don't want to go out and waste your time and your realtor's time looking at homes that are outside of your price range. And so going through the pre-approval process will ensure that you know exactly how much you qualify for, and you know what your payments are, so you know exactly what your budget's going to look like. Now, why use a mortgage broker? I might be a little bit biased, but let me tell you about using a mortgage broker. What we do is we shop over 40 different lenders to find you the best rate and best product. And then the broker is actually paid by the lender. And the reason for that is that the bank has minimal overhead costs in the broker channel. So what they do is they have an underwriting office in Vancouver and maybe also in Toronto. And all the underwriting offices do is they just process mortgages day in, day out. And they only are dealing with the deals that the brokers think are a good fit for that lender. What ends up happening is if you look at the branch level versus the broker level, typically when a good broker sends business to a lender, about 90% of those deals that are sent in actually turn into a funded mortgage, which is where the banks make money. If you look at the branch channel in general, it's about 30%. And that's just because people are approaching and applying to the bank and they may or may not qualify. So we are effectively a filtering system for the bank where we send the banks only the good business that should actually fund. On top of that, there's no brick and mortar overhead. There's just salary costs, and there's way less salaries through the broker channel. They only pay us if the mortgage funds, and they don't have to have a marketing budget to attract new customers because the brokers are sending them in the business. So that's really the difference in the business model, and that's why the broker channel has very competitive interest rates, because they have to be very transparent, or else they don't get any business from mortgage brokers. Another nice feature is there's no bias in negotiating. The lenders don't pay us any different depending on the interest rate. They just say, here's their best rate, take it or leave it. And so you're going to find that you don't have to go through any biases or negotiating or anything like that using a mortgage broker. And mortgage brokers just do mortgages. There's a lot of people that work at the bank that do mortgages, and they do investments, or they do mutual funds, and they open up bank accounts and things like that. So mortgage brokers specialize in just doing mortgages all day long. And in general, because mortgage brokers are paid on a commission, a lot of the people that are better at doing mortgages like to be in the broker channel, because if you're good at what you do and you're in commission-based business, then you can make more money as a mortgage broker. So a lot of the time, if people do work in the branch channel and then get good, a lot of the time they like to move over to the broker channel. Last but not least, mobile, flexible, and with you for life. Mortgage brokers are, take pride in being flexible, mobile. A lot of mortgage brokers work evenings and weekends to accommodate you, even if that's outside of banker hours. The intention here is that we're trying to create a relationship with you for life. A lot of the time what ends up happening is people go to the bank, and I know I've had this experience a number of times where all of a sudden the person that was representing or working with me has left and moved. And if they're good, they get promoted. And if they're not good, maybe they get shifted to a different department. But I find that the turnover ends up being quite high, whereas mortgage brokers, if they're good at what they do, then they usually don't leave the business. Now, getting a mortgage, it's not the most fun thing ever. I'm not going to sugarcoat it. We do try to make it easy by keeping you in the loop on the process. Green Mortgage does have a specific process that we use. We have a very dialed in system, and it's stage-based, and it helps walk our clients through the entire process. And so we try to map out and provide our clients with what's called our roadmap. And it talks about all of the different stages. And as you reach these milestones of the transaction, then we're consistently updating you and giving you an idea of which stage we're at, and an explanation of what that stage means and how long it takes to achieve the stage and get to the next stage. So we know that this is a very difficult process. It can be very you can be very difficult to go through and frightening in some cases. And so we really want to hold your hand through that process and make sure you feel comfortable going through and getting a mortgage. So I talked a little bit about this earlier, but getting a pre-approval is very important. Knowing how much you qualify for and getting that rate hold for 90 to 120 days is really important. And making sure that you're as prepared as possible, because you want to make sure that you're putting together and putting forth the most attractive offer possible. If you write an offer and you don't have a pre-approval and you don't have that confidence that you can get the financing, then sometimes that makes that competitiveness in the offer a little bit weaker. So if you're competing with 3 other people and you don't have a pre-approval and the other 2 people do have a pre-approval, sometimes that can make it a little bit more challenging for the seller to accept your offer. So that's the first thing. And the second thing is, when you write an offer, the clock is ticking. And now all of a sudden you have a certain number of business days to get all of your ducks in a row. If you already have the pre-approval and you have provided the documents, you can focus your time on the due diligence on the property itself, which is a lot of work. You may be buying in a strata company. You have to read mountains of strata paperwork and make sure that you're comfortable with the property. You don't want you also having to focus on gathering up all of your documents and getting all that in order. So it's better to get pre-approved and get that done all in advance. So how do lenders qualify you for a mortgage? Well, there's a number of different things that they look at. Credit scores is the first one. In general, the absolute bare minimum is 620, but realistically, most lenders want it to be 680 or 700 plus. And so if you're on Credit Karma or even with your bank, you can check your own credit that way. Make sure that you're paying attention to what your credit score is, because you do want to make sure your credit is in good standing. For income, debt servicing, and the amount of income that the lenders use, they only want to allow 44% of your income towards all of your debts. Now, I will say that very recently, and I should change the slide actually, for years and years, it was about $20,000 in income equals $100,000 in borrowing power. I'd say that as of today, because interest rates have recently risen, it's actually closer to about $25,000 of income per 100 grand of borrowing power. And that means if you have a household income of about $100,000, you're probably qualifying for about a $400,000 mortgage. Now, down payment, the minimum is 5% down. The amount then in the way that they calculate this is it is that 5% on the first 500 grand and then 10% on the balance. And anything less than 20% down needs mortgage insurance, which we'll talk about in a slide or two. If you're buying over $1 million, that requires 20% down. There has been some talk with the government about potentially increasing this number, and that was before COVID. COVID hit, and now all of a sudden that seems to be off the table. So I'm not sure if they'll be introducing this and at what point. But as of now, if you buy over $1 million, then you must put 20% down or more. And on the property should be in good shape. It should be marketable, good location, no issues, etc. In general, as long as something is livable, you can often get a mortgage on it. But it's in really rough shape, it can be more difficult to get a mortgage on the property. So just keep in mind that the property and the collateral is very important as well. Now, for mortgage insurance, there's a certain bandwidth here that the lenders all have to adhere to. And so this is the premium that's added to your mortgage amount when you get a mortgage. So the mortgage insurance, if you put 5% down, is 4% of the loan amount. If you put 10% down, it drops to 3.1%. And if you put 15% down, it drops to 2.8%. If you put 20% down, then there's no mortgage insurance premium. So this is an important graph to understand. Just note that this is not an out-of-pocket cost. It gets added to your mortgage, but it does then get factored into your monthly payments. So make sure that you understand and aware of the mortgage insurance. Another thing that's very important to understand is down payment. So lenders prefer what are called traditional sources. That would be your savings, RSP withdrawal, a non-repayable gift from immediate family. If you sell another property, you can use the funds to buy, the proceeds to buy another home. Or if you're borrowing funds from proven assets. And so that would be if you have another home and you can borrow against it, then CMHC and the insurers are usually okay with that. However, they often can also allow non-traditional sources in some cases, but it is more difficult. There are some programs you can actually borrow your down payment. Believe it or not, you can actually buy a property and borrow your 5% down on a credit card. It seems crazy to me that they have all these restrictions, and yet you can actually go and borrow down payment from a credit card and use that for down payment. However, it's very challenging to qualify because they use a very high payment on that credit card in order to qualify you. You can actually get a gift from a non-immediate family member. However, this usually means that it needs to be an aunt or a grandparent or something like that, somebody that's still very close to you. Another one that very few lenders actually recognize is something called sweat equity. So if you put value or work into a home, then there may be an option where you can use that as your down payment. Although it's been a very long time since I've done any deals with sweat equity, probably over 15 years actually. And then they used to have options for cash back, where up until 2013, you could actually get a cash back mortgage and you could use the cash back towards down payment. There are still cash back mortgages available, but the cash back now is used to pay off debts or just to put money in your bank account. You cannot use the cash back as a valid source of down payment anymore. So in closing costs, when you go buy your first home, there are some closing costs. There's the property transfer tax, which is about 1% of the first 200 grand and then 2% of the balance. And of course, if you buy under 500, you don't pay any of this. If you're a first-time home buyer, 500 to 525, you pay a percentage of it. Over 525, you pay the full amount. Legal fees are usually about $1,200 to $1,500. And so that's the lawyer or notary registering your name on the title, registering the mortgage on title, etc. I'll say that most of the legal fees that we've been seeing in the last 12 months or so, inflation, probably closer to $1,500 a month now. And then there may be some adjustments on the transaction as well. And when I say adjustments, for instance, property taxes are due July 1st of every year. Now, if you buy a home and you complete on March 30th or 31st, that means that the existing homeowner has lived in the property for the first 3 months of the year, but the full property taxes are due on July 1st, which means that they have to pay you back for those 3 months that they lived in the property. However, if you close, let's say on July 31st, well, now the current homeowner has already paid the property taxes July 1st, and now you have to repay them back for those 7 months or for the next 5 months that you're going to be living in the property. So There can be some adjustments on property taxes and then strata fees and other things like that. So don't expect that the legal fees may be the only thing. You need to also understand what time of year you're buying the property. And some lenders also may require you, if you're buying the property right before property taxes are due, the lender may ask you to prepay those property taxes so that they know that they're paid right away. So if you're pre-approved and you're now looking at writing an offer, this is the process. So you're writing an offer, and usually that's it takes a day or two to get it accepted. That's usually where the negotiation happens, and that's when your realtor is able to offer you some assistance with the negotiations and how to do that. Once you get it accepted, that's when you want to begin the financing as soon as possible. So right away, that's when you want your realtor to send over all of the documentation necessary over to your broker to make sure that they understand what's needed and how what kind of financing you're looking for. You also immediately want to work on doing your due diligence, and this includes reviewing the strata documents, arranging an inspection. In many cases, you will arrange the inspection, but you might try to line up the date so the inspection happens the day or two after you expect the mortgage approval. Now, eventually, after you've done all your due diligence, then you're removing the subjects. So when you write the offer, you usually write a subject removal date of 5 business days, 10 business days after the offer. Something's going to be longer. Certain transactions can require a longer subject removal date, but usually 5 to 10 business days after writing the offer is when you remove the subjects. And typically, after you remove the subjects, usually 24 or 48 hours after that, then you're providing the deposit. So the deposit is usually between 3 to 5% of the purchase price. And this amount is a credit towards all of your closing costs at the closing. And so the lawyer will actually do something called the statement of adjustments, and they show all the money coming in and all the money going out. And the money coming in would be your deposit, and that's going to help offset all the money going out. If your deposit is 5% of the purchase price and your down payment is 5% of the purchase price, then you're probably only bringing in a small check at the lawyer's office just to balance out a couple of the small little things like the lender's or the lawyer's legal fees, and if you had any property transfer tax. And typically after this, usually closing happens anytime from 30 to 60 days after you remove the subjects. Really depends. Sometimes it's shorter, sometimes it's longer. But in general, this is the process of writing an offer. So in the due diligence part, there's quite a few things that you want to look at. You want to make sure that you review 2 years of strata, annual general meetings, and the strata minutes. There's something called the strata form B, which goes into a bunch of details about the strata itself, the strata budget, and something called the property disclosure statement. In British Columbia, there's a property disclosure statement. In other provinces, I don't think most provinces have this, but some do. And if it's a detached home, there may be a survey, and that shows where your house is on the lot. Every once in a while, you may find that the survey is very different than what the expectation was, and that can be in your favor or not in your favor. So it's something that is important to understand. There's also ensuring that any oil tanks that are on the property have been removed. Nowadays, it's quite rare that any oil tanks still remain. But if somebody has owned a home and hasn't sold it for 40 or 50 years, there may still be an oil tank underneath there that they never had to take out and get rid of. Lenders will not lend on a home that has an oil tank in it. Any receipts and warranties for any major repairs. So making sure that the roof has been replaced and the furnace, etc. These are all important. And making sure that any work done had a permit. There's a lot of properties that have work done that did not have a permit. So that's important to understand too. So once you've done your due diligence and you go into the closing, this is where you go to the solicitor. So solicitor is the notary or lawyer, and they're going to be the one that handles all of the money, all the in and out transactions, ensuring that you have your insurance, ensuring you get your mortgage, and you go sign the legal documents at the lawyer's office. You're usually signing the documents the week of closing. Insurance is very important. If you're buying strata property, the building insurance, which you contribute towards with your strata fees, will cover the shell of the building, but it will not insure the contents. And when I say contents, that includes any appliances and of your furniture. So it's usually cheaper to get a policy just on in the contents. But you're also getting a deductible on the deductible. A lot of strata deductibles can be $10,000 or even $100,000. If let's say you left the tap on and you caused a flood, that deductible might cost you $100,000. And so part of your homeowner policy will be providing a deductible on the deductible. So that could say, okay, well, you have a deductible of $10,000 if you have to pay a strata deductible. So interesting how that has changed over time. Making sure you arrange movers. Some of our clients have made the mistake of trying to arrange movers too late. If you're trying to move in July or August, which are traditionally the busiest months, especially if you're trying to move on July 31st, that is always the busiest time, like the busiest day of the entire year, every single year, or in that week. Make sure that you arrange movers well in advance. And then closing, this is where the money exchanges hands, and the lawyers and or notaries handle all of this. And usually the possession date is a date after the money exchanges hands, and that's when you get the keys and you get to move into your new home. So a couple of tips. First of all, the RSP out of nowhere trick. So I want to talk about this because if you are wanting to buy a home in the next couple of months, as long as the RSPs have been there for 90 days before you remove them, then you're able to actually pull them out. And so one of the tricks is if you plan on buying a home in 3+ months from now, you could actually put money into your RSPs. And unfortunately, the date just passed or is just passing. But if you do this early enough in the year, and you contribute before the taxes are due, you can actually get a tax refund on your taxes, and then immediately 3 months later, pull the money back out of the RSPs towards your first purchase. So the money out of nowhere trick goes like this. If you put $10,000 into RSPs, let's say that you're at a 30% tax bracket, you would then get 30%, i.e. about $3,000 back on your tax refund, which means that now you have $10,000 in the RSPs and $3,000 in cash on the tax refund. When now you go buy your home, you take the $10,000 back out, and now you have $13,000. So you turn $10,000 into $13,000 towards the purchase of your home. Now you do have to recontribute back into the RSPs over a 15-year period, but in general, the financial stretch to get into your first home is very real. You would expect that over time your financial situation will get easier, especially if you own your own home, and making that contribution back into the RSP should be simple. I want to talk about vehicle loans. Vehicle loans are a killer. The number of times that we've had clients where they just got a new truck. I'm going to blame them Albertans for this one. I see it all the time. A new F-150 truck with a $1,200 or $1,400 payment can be a real problem. Now, to put it in perspective, a car payment with a payment of $500 a month will reduce your borrowing power by about $100,000. Pretty significant. And the reason for that is the mortgage payments per $100,000 are almost the same. Also, unsecured debts are a killer too. $20,000 in unsecured debts, like credit cards, lines of credit, will also reduce your borrowing power by about $100,000. So this is another key. And this is why earlier we mentioned, try to make sure you get all your payments and all your debt or all organized well in advance. So if you have any questions, book a consult with us today. You can also learn more on our website. We have upcoming webinars, a first-time homebuyer guide, a lot of sheets that you can download, and an FAQ. Also, I know that I might be jumping the gun here a little bit because many of you are first-time homebuyers, but I also wrote a book called Rockstar Real Estate Investing for anybody that would like to learn more about investing in real estate, or even if with your first purchase, you want to learn more about how to use this first purchase as maybe an investment. Feel free to send us an email at info@greenmortgageteam.ca. I'd be happy to put a copy of our book in the mail and send it over to you so you can review that too. So it's actually one of Amazon's bestsellers. So if anybody would like a copy of that, please let me know. Other than that, if you want to contact us, you can go to our website, greenmortgageteam.ca. Go to our website or email us at info@greenmortgageteam.ca or call us at 604-229-5515. Thanks so much for coming out. I'll go to the chat and answer some questions now. Michael has a question. So when the bank pays you direct for cost of using a mortgage broker, are you not working in the best interest of the bank or the borrower/buyer? So even though the bank is paying us, we are still acting for our borrower to make sure that they get the best mortgage product. If the bank comes back and has different conditions or is suggesting that they don't want to give the borrower the type of mortgage that they want, because we have a number of different other options, just because the bank pays us doesn't mean that we represent them. Now, from a fiduciary duty, we have some duties that we have with the lender, and that would ensure that that we're not supplying them with fraudulent documents or fraudulent information. So there are certain things that we have to adhere to from a fiduciary perspective. But from our perspective, we're representing our borrower and trying to get our borrower the best mortgage. Okay, I think those are all the questions. Any other questions? I don't see any questions in the Q&A or anything in the chat. Anything here? You guys are taking it easy on me. Okay, well, maybe if we don't have any questions, then I'll leave it at that. Thanks so much for coming out. Feel free to send us an email, info@greenmortgageteam.ca. If there's anything that comes up, please let us know. If you'd like a copy of our book, email us as well for that. Happy to send you guys a copy of the book, and looking forward to helping you. So enjoy the spring, enjoy the summer when it does come. Can't wait for that. And yeah, ready to buy. Exactly. Looking forward to helping everyone here. So thanks so much for coming out, and look forward to talking to you all soon. Thanks.